Hi guys, welcome back to the channel. My name is Dave, and today we're talking about XLE. This is from State Street Global Advisors. This is the Spider Select Sector ETF, all about energy. And if you could go back and tap yourself on the shoulder, early in 2022, you would have said, get out of everything else, all those other sectors, and just focus on energy. Buy XLE. Because you'd be up 40%. You'd be staring down at all your buddies going, what are you guys doing? Why aren't you buying energy? You've lost 20, 30% in all those other sectors. Gosh, if you would have just listened to me. So today it's all about XLE. We're going to find out if this is something that we can still buy and add to our portfolio, at least for me. I know it's just about me. If this is something I should be buying and adding to my portfolio, or selling, getting out of it, because I do own some shares, or is it something that we should be trading, maybe wheeling? So it's all about XLE today. If that is what you're looking for, please stick around. Whoop. Maybe the title of this should just be, if you can't beat them, join them. If you go back to the beginning of 2022, we had rising inflation. We started raising interest rates. Oil prices started shooting through the roof. Oil companies are making a ton of money. They distribute a bunch of money. We'll take a look at all that. But that's the first thing that really hit us upside the head, right? We started seeing gas prices go through the roof. Now, we kind of got that under control for a little bit until OPEC Plus came out and they started controlling the supply again, shutting off the control valve just a little bit. And that's kind of what is providing, a lot of people think, a little bit of a floor to oil prices. Now, that doesn't mean they're not going to revert and open that valve right back up. Of course, we got China sitting there. They're going to open up at some point. They're going to have a big demand for oil. So it's just kind of an interesting period here where maybe we do have a little bit of a floor, and maybe we don't have that high of a ceiling, but that sounds a lot better than the rest of the market right now. And that might provide us with a trade at this moment. So let's take a look at how XLE has performed versus some of these other sectors at this time. So let's start by looking at a comparison chart of XLE versus some of the other sector ETFs. Now I picked F for financial, K for technology, I for industrial, V is healthcare, and RE for real estate. And this is the 1 year chart that we're looking at right now. And you can just see over the last year, it's really outperformed, right? Up over 40%, whereas healthcare is the next closest, down about 2% over the last year. Now, if we go to year to date, energy has just owned the market compared to the rest of these. So over the last year to date, we're looking at still up over 40% for XLE, and healthcare is the next closest, down look about 11%. So that's a 50% swing, folks. That's huge. So obviously one of these is not quite like the other. Go ahead and sing the song if it'll help you, but we don't know what's going to happen next, right? If we go out one more month, for all we know, this is going to crash right back down to be with the rest of these. But year to date, energy has been where you would want to have all your money. Obviously, it's just been really impressive and just how much it's separated from the rest of these. So the charts that you just saw and the rest of this review is going to be here on Seeking Alpha. I am an affiliate of Seeking Alpha. There are affiliate links down below that'll give you a nice big discount if you like this type of content. Only do it if you think it'll give you personal benefit. But there's also a free version you can kind of dip your toe in and kind of play around with a little bit. I know for me, the more I use it, the more I like it. So I always have Seeking Alpha open. I've got my Fidelity account open, my E-Trade account open. They're there all the time so I can do my analysis and my research and read any kind of news that might pop up. So I get into it more and more, and I've been utilizing it a lot. So now let's jump in and take a look at XLE, the Energy Select Sector Spider ETF. Sitting there at $80.28, down big on Friday, 3.73%. So you can see the 1 year chart here, and expense ratio of 0.11%. That's kind of in line with a lot of the sector ETFs that they offer, and others do as well. So 0.11 or 11 basis points, or $11 per $10,000 that you would invest into XLE. Now, it does pay a dividend. It's pretty nice. It's done quarterly. The dividend rate is $3.06, which equates to about 3.67%. So a nice, healthy dividend from XLE. You know, a lot of oil stocks tend to pay out nice, healthy dividends. A lot of them can afford it too, because a lot of them are making tons of cash and have a lot of great free cash flow that they can utilize and pay out those dividends. So I know I got a lot of dividend investors out there, and XLE sitting at 3.67% looks pretty darn good. So now a lot of the select sector ETFs like XLE do have a decent amount of assets under management. So this one's sitting there with over 33 billion in assets. So pretty popular, lots of liquidity. So if you're into options as well, they do offer options, and pretty easy to jump in and out of those options as well. If we take a look at the holdings for XLE, you're going to see Exxon and Chevron make up over 40% of the fund. So if you're going to get into this, you might do a little research into Exxon and Chevron. But if you haven't looked at those before, coming out of the pandemic, they still are making a lot of money. So not what they made back in 2012, but they turned the corner here and they rake in a lot of money. And they have a lot of free cash flow, like I said, so they can support that dividend. So I don't see anything changing there at this moment. Whereas in some other sectors, I look at some individual stocks, and that's the question. You can see some of those dividend rates really rising right now, and you wonder, will they be able to fund that going forward? And I don't think that's going to be an issue with something like XLE and the holdings that they have here. But we can look through the rest of these top 10 holdings, and you're going to see Schlumberger and ConocoPhillips and Occidental and Valero and Devon. So that's the main holdings. These top 10 make up over 75%, and there's only 25 holdings altogether within this ETF. Now we can jump over and take a little bit of a closer look at the dividend. We said it was 3.67%. It was 85 cents that they paid out. The ex-dividend date was 9/19. So the next upcoming, you'll want to own those shares before the middle of December in order to qualify for that next dividend. Now it is going to be a little bit erratic up and down quarter to quarter because it is obviously going to depend on all those 25 companies paying out that same amount every single quarter, and that isn't always the case. So there is going to be some variability to this 85 cents. I think if you look at the dividend history, you'll see that there's even one crazy one here for $1.79. Not sure what that was about. I'd have to go back and look. But you can see last year they paid out 70 cents. And the last couple looks like 85, 82, and 70 cents. So there's going to be some variation month or quarter to quarter when it comes to that dividend. Now, there are plenty of peers, too, that you can take a look at if you're not too thrilled with XLE. Again, a lot of these are going to be similar. I always focus on that expense ratio, and you're going to see that similar to VDE, which is another option that you could go with. This is obviously one of the larger funds, so $33 billion worth. But easy way to compare it using Seeking Alpha here. And I would like to point out again, options. So I'm probably going to approach this from an options perspective. I do own some shares. I'll talk a little bit more about that in retirement account, but I'm looking at this maybe as a trade. So if you pull up their options tab here, you're going to see the different calls and puts that are available, and you're going to see the different strikes and the prices. So you can get all that as you move across here. And you can see volume when it comes to options is, it's not the volume from the stock itself, it's actually the option volume. So the number of contracts that were traded that day, okay, today. And then open interest is actually how many contracts are still in existence, because open interest can go up and down, right? So you can come here and you can find and see maybe which ones are the most liquid, have the most open contracts at the moment. So like here we got the $55 call for October 21st, which is the upcoming week. You've got 1,000 contracts that are open right now. That means you got 1,029 buyers and sellers at that $55 strike. So keep that in mind too, to kind of look at this kind of information before you maybe jump into a trade, making sure that there's plenty of open interest. That area will help you between those bid and ask spreads. So last piece of information here. This is the chart of XLE over 10-year period. And you can see during those 10 years, it did nothing. So investing in this thing for the long term, all you would be doing is collecting some dividends along the way. It hasn't performed well at all. And this is versus the S&P 500. So please keep that in mind. But if I start looking at all these different sector ETFs right now, and you said, which one would you invest in? It's going to be XLE at this time. I still think a lot of these other sector ETFs have further to fall, just like the rest of the market. Whereas I feel like XLE right now is going to be artificially supported by OPEC Plus, which of course could change at any time. But I love the fact that they continue to make a lot of money and they have great free cash flow, and I think they can support that dividend. So financials look great. And I think going forward, at least in the short term, this is where I'd want to put my money. So with all that information, what am I going to do? Well, I have a plan.
I have a plan.
I do own about 200 to 300 shares in a retirement account. Those just sit there. They collect the dividends. I'm not going to change any of that. But with the current situation with XLF, I plan on wheeling XLF, selling puts, selling calls, generating as much income as possible. So I already have one put sold, and I have 100 shares, and I have a call sold against that. It's been working out pretty well in 2022. So I'll show you that position, and I'll show you where we sit right now if you wanted to get started by selling a put. So here's an option chain for XLE, and we're looking at the November 11th expiration, which is 27 days from now. So this is the weekend. It's October 15th, 2022. Taking a look at this and looking at it from, going to try to be fairly conservative here. So I have bought 100 shares of XLE early in the year at $56.61. So I've seen great appreciation from that. And I've been selling calls against that position as well. I've collected $880 in credits. So my current basis in the stock is $47.31. So this is looking great, whereas plenty of other trades don't look great this year. I can point to those too, but this one looks pretty good. So sitting there with my basis that low, and I've got a call sold at 73 out towards the end of October. I've also got a put sold at 73 with it at $80.28. So we'll see how that shakes out. But that's kind of my whole idea here with XLE is I'm going to continue to roll these options and collect as much credit as I can because I think I've got a little bit of a floor and a ceiling, and I can use that to my advantage as somebody who likes to sell puts and calls. So just looking at this chain right here, if you wanted to sell something out about a month with the stock sitting at $80 right now, you could sell a put, for example, being fairly conservative, all the way down here at 70. And we'll take a look at this in a calculator here in a second. It looks like it would generate around $91 of premium that you can put in your pocket right now. So that's pretty far out of the money. And we'll look at a chart as well. That looks like a delta of around 15. So a probability of a 15% chance of this actually expiring in the money for the person that would be buying this put. Whereas you're selling it, so you've got a pretty high probability of this hopefully just expiring and you keeping that $91. So is it worth it for us to chase $91 in premium and add additional risk to our portfolio? Well, I get it. It's a $70 put, and that's way out of the money, over 12% from the current price. But let's flip over and take a look at a chart here, and this is a one-year chart on Fidelity. And what we're saying is with the stock at 80 right now, selling the $70 put. And we do see some support here, right around that $70 level. But it'd feel even better at 65. See, when we're trying to wheel options, we want to not take assignment. Now, if we do take assignment and it rebounds, that feels great, but we're still trying to avoid that in step one. So maybe we should wait and see if it starts to test this 200-day moving average. And again, I'm just thinking out loud here, but we have big earnings coming up. That includes Exxon and Chevron, which is a major component of this sector ETF. And along with that, we have all the big tech companies reporting at the end of the month as well, and those will have an impact on the market. So it might be better for us to wait a week or 14 days, kind of see how this plays out during that earnings period. Again, just thinking out loud, but things to consider when you're looking at selling that first put. So just to illustrate this trade a little bit better, I'm using my cash secured put calculator. Now this is free to download, and I use this tool just to simply illustrate to people how this trade might work. Now, if you're not familiar with options, I'll link my playlist over here that's all about introduction to options. But I'm going to work through this fairly quickly. So what we're talking about is today's date, one contract XLE with an expiration out about a month, 11/11, which is 27 days from now. And with the stock at $80.28, we're going to sell a put at a $70 strike price, which means the stock, XLE, has to fall 12.8%. I should say ETF. Drop 12.8% in order for it to get assigned to us below that strike price. So for that, we could collect $91 in premium right now, and we go have our sushi dinner, and we celebrate. But we also have to have $7,000 of collateral sitting by in case we get assigned these shares at the end of this whole cycle. So if the stock falls below 70, we're going to have to buy it at that strike price, and we're going to need to buy 100 shares of it, and that costs us $7,000. So we have to keep that in mind. Now again, 27 days and $7,000. So three things can happen, or a couple different things can happen here. So first of all, stock above the strike price, above 70, right? The option simply expires. We keep our $91 in premium. That represents a 1.3% return over 27 days on our collateral. And if we annualize that, it's 17.5%. So we did this all year long, same trade, we get 17.5%. Sounds pretty good. Now, what if the stock does start to plummet? And that's where this calculator comes in handy, where you can say, well, what if it drops all the way to 65? What happens? Well, we lose $500 between the difference between 70 and 65 on 100 shares, but we collect $91 in premium. So currently, if it drops to 65, we're down $409, and we're going to wheel this sucker. We're going to sell that call next, right? We're going to try to get some of that money back. What about our break even? Well, our break even is $69.09. That's the difference between 70 and the $91 that we collected in premium. So we collected, right? So we can lose $91 in the stock because we're going to make $91 when we sell the put in the first place. And that gives us a break even of $69.09. So just a quick way to visualize and assess our risk here. What kind of collateral do we have at play? What kind of return can we have if everything goes our way? And if we annualize that, what does it look like? And the downside in case things work against us. So again, just a quick way to visualize our trade. So there you have a little bit of a review of XLE and my plan as far as trading this to generate some income. Now, if you have any questions on this at all, please ask down below. I really appreciate you watching. If you like this type of content, please like and subscribe, and we'll see you next time. Thanks so much. Have a great night. Whoop.